Hi, I'm Mark Palmerino. I'm a partner here at CCR Wealth Management. It's April 15th, tax day 2019, and we're here to do our quarterly webcast. I'm here with John Maher, our Chief Investment Officer, and we're going to talk a little bit about where our firm sees the markets going in the next quarter. John, in our most recent market update, you briefly discussed global PMI, and you had some graphs that you used to project that in our outlook. Can you explain a little bit how PMI works and why it's an important tool for us to use?
Sure. PMI, if you Google PMI, you're going to come up mostly with private mortgage insurance, at least on the first page. So we assure you, we're not talking about private mortgage insurance. A PMI is an excellent gauge of economic activity, in the particular country. So there's a couple different flavors of PMI. There could be industrial PMI. There's also service sector PMI. But it is helpful it's helpful for business managers. It's helpful for inventory managers to establish demand in the future for their products. For example, if you're in charge of inventories, buying raw materials, you don't necessarily want to go out and buy a bunch of raw materials if the end demand for the widget or whatever it is that you're manufacturing clearly has been falling. And PMI would give you a sense as to whether that's happening. The other applications for PMI, which by the way, I'll back up, Purchasing Managers Index, that's what it stands for, is with analysts, economists, and I would even say the Federal Reserve is a major consumer of PMI information. So it gives us an aggregate idea of what the demand is in an economy. PMI in the US is aggregated by the Institution for Supply Management, term some people may have heard or read about. Outside the US, HMS Market Group. But the basic gist of the information, whether it's US or non-US oriented, is the same. It's survey information. So in the US, for example, there's a survey that's sent out to over 400 companies, and they're asking about inventory levels, supply deliveries, levels of production, et cetera. And they're gauging whether these data points are an increase or maybe they're a decrease from the prior month. The information is weighted, and it's you come up with basically a number. The number is between 0 and 100, but the magic number for PMI is 50, as we intimated in the outlook. A PMI of greater than 50 indicates an economy that's in an expansion. If the PMI is less than 50, the economy, it's an economy that's shrinking. And the further away from 50 you are on either side is kind of the greater move in that direction. So 50 is the magic number. Last month we did, and we can throw up again briefly on the screen if we have it, PMI measures for some of our major trading partners. And we looked at Germany, we looked at Japan, we looked at France. And the point of bringing up PMI was kind of a launch into the discussion of really fairly acute slowing in global economies.
It's completely independent from GDP, both domestically and internationally, not tied to that in any way, right?
Well, you would look at PMI more as a leading indicator, which would give you an idea of where GDP is going. Now, having said that, I would also mention that PMI is a monthly data point. So given the fact that it's monthly, it also tends to be very noisy. So the more important thing about PMI is really trying to establish what is the trend. 1 month to another month could show a real anomaly, but the trend is the trend. And in this case, we're really seeing some defined trends outside the U.S.
John, recently in the fall, there's a lot of discussion about an inversion of the yield curve, and I've fielded a lot of questions from clients about this. Can you explain what the yield curve inversion means and what we can discern out of that?
Yeah, and there's a lot of prognostication about recessions related to the yield curve. So the yield, first of all, let's talk about a normal yield curve, and we can put up an example of what a normal yield curve looks like. You see it's kind of a concave graph. If you lent me money for 3 months or for 10 years, I would expect to pay a pretty wide difference in interest, right? Because the risk to you is different over 3 months as opposed to over 10 years.
Just like people with a mortgage, a 15-year mortgage is usually lower.
Exactly.
Rate.
So a normal yield curve shows this progression of interest rates going up over time. Now there may be a certain point in the yield curve where the rate isn't rising as much, say, per time period, but we call this the term structure of interest rates. And the term structure of interest rates is an important factor in looking at and considering economic things. It's also important when we consider risk premium and when we consider time horizon. The yield curve always moves. It's always changing shapes, so to speak, because interest rates move every day and often every minute of every day. But there's both theoretical and practical implications of the shape of the yield curve. So theoretical implications, really, I mentioned risk premium or risk premia. It's the yield curve kind of gives a sense of how investors view the future conditions in the country economically. And because the yield curve, the term structure of interest rates, the pure yield curve we're talking about is consisting of treasuries. So it's the risk-free rate. There is no risk involved in it. So you add a risk premium, whether you're talking about corporate bonds on top of that, or even equities. It gives us a sense in the future of how much investors may be willing to risk to get the kind of reward associated with that. An inverted yield curve is an uncommon instance where you will end up getting a higher rate of return if you're an investor on, let's say, a 2-year note as opposed to a 7-year note. You would actually get a lower rate of return on a 7. That makes no economic sense. It does happen from time to time, but not making economic sense is obviously not good. That could also lead us to the more practical application of the yield curve. Traditionally, the yield curve has been associated with the banking sector's willingness to lend money, right? So net interest income has been a large portion of bank profits. The steeper the yield curve, right, the more money they're making on the long end as opposed to the deposits they have to pay on the short end, the greater the profit margin for a bank. A flatter yield curve, less profit than an inverted yield curve. Well, we saw an inverted yield curve in 2008, rather substantial, and we know what happened, to lending. And it's viewed with some importance because bank lending is kind of the lifeblood of this economy and of really any economy. So that is the yield curve. We did have a pretty flat yield curve for most of the year over the last 12 months. Briefly, the yield curve inverted in December. And then for much of the last quarter, February and March, we have had an inverted yield curve where you have been able to get, an equal rate of return on, say, a 2-year and a 7-year, but the time period in between has had a lower rate associated with it.
Well, with that being said, even though it is a precursor of, or has been a precursor of a recession, it doesn't mean that one is absolutely going to happen, right?
So there's, it's undeniable since probably for the last 60 years, since the whole post-war period, a recession has followed an inverted yield curve, but there's a lot of noise inside that data. And I don't think, certainly today, CCR Wealth Management is looking at the fact that we've had an inverted yield curve and saying, therefore we can bet on a recession. A couple things to think about. Recessions have almost always been caused by the Federal Reserve pushing short-term interest rates well above the rate of inflation, right? And that's been in their attempts to slow the economy down. Well, you get an inverted yield curve when that happens. And, I've written in the past, every recession is caused by the Fed raising interest rates. If you look at today, and we do have a graph that shows this, but the rate of the short-term rate of money is not particularly higher than the rate of inflation. I think only about 30 basis points or so. The other thing to consider is that, and I think this is a huge point to make, we've had a massive pivot over the last 3.5 months on the part of the Federal Reserve. An inverted yield curve leading to a recession doesn't make a lot of economic sense. It doesn't make a lot of practical sense when you consider the dovish stance that the Fed made back in late December, early January.
Right, and their stance in the fall seemed to be that they were a long way from neutral in interest rates, and now they seem to be taking a much more patient or dovish look, and that's really when the long-term rates have moved down.
Right. I mean, this searching for a neutral rate. The Fed has got a terrible track record of predicting gross domestic product. They've not had a great track record in predicting where their own future interest rates will be. And I would also note that the yield curve itself, if we take that correlation with recessions, it gives absolutely no indication of what the timing is going to be. I'd add also that, let's look at, or try to gather a consensus of whether the inverted yield curve leads to a recession. And there is absolutely no consensus out there. And there's just over the weekend, Jamie Dimon, person who much of Wall Street listens to, said he sees the current economic growth in the U.S. lasting for a number of years. Not that nobody's counting quarters anymore.
Well, in the fall, that seemed to be everything. It wasn't, are we coming up to a recession?
Yeah, it was when. It was when. And our point is basically it is very far from time to panic in the U.S.
Yeah, I think the average after a prolonged inverted yield curve is somewhere around 22 to 23 months to the beginning of a recession. So, I mean, if it happens.
Right. Does mowing the grass cause the grass to grow, or does the grass, it's a chicken and egg thing. Great.
I want to double back on something we were talking about earlier with respect to PMI and the growth rate internationally. We've recently reduced our international exposure in portfolios to the lowest bars of since our inception, actually. Mm-hmm. Can you talk a little bit about what you're thinking about that and why we're cutting back? I'm assuming a lot of it has to do with what you were mentioning earlier about the global slowing that we see with PMI.
So I think the most important point I would want to make here, and hopefully it came out strongly enough in the outlook, but I've talked to advisors in the office about it. We are not retreating from equities. This is not a retreat. This is not a defensive crouch, so to speak. I could characterize it as a more defensive move, but it's not it's not a move made out of trying to market time. It's not a move to to attempt to avoid recession somewhere. We are global investors. We believe fully in diversification. But our own philosophy says that we're also tactical investors. Tactical investing is a function of seeking it. Trying to avoid potholes if you can see them. You can't always. But it's also looking for opportunities. And when we look around the world, and it does go back to the question of PMI, we look around the world, we're looking for opportunities, right? We're not in a defensive crouch. So we're going to pull up, there's another look at PMI that really gives you the sense of the trend. Remember, I said that it's the trend that's important with this measure. And as you can see, compared to the United States, the Eurozone and Japan and China have significantly negative trending PMI numbers, and some of those numbers are well below 50. GDP forecasts in the U.S., we'll call it 2.25, 2 to 2.25. GDP forecasts in the Eurozone, 75 basis points to maybe 1.25%, and in Japan, you're looking at about the probability of about 1% growth. So, with that in mind, I also mentioned the fact that, and not for the first time, that central banks around the world have really no ammunition left. Interest rates are at zero. quantitative easing is still going on. When the central banks, one of their responsibilities is to kind of goose the economy through the dropping of interest rates during a time of slowdown or even recession, they're already at zero. And in some cases, they're in negative territory.
Nowhere to go.
Where do you go from there? So, that's another reason we're seeking more opportunity here in the U.S. And the U.S. rates are still low. They're still historically low, but I wouldn't characterize the move away from non-U.S. as defensive.
John, typically in late cycle economies, the leaders in the market or the leader in performance have been commodities and inflation-linked securities. Is that something that we should be looking at, or what are we doing with our portfolios to, if that's something we should be taking advantage of, or?
So my answer is yes and yes. Yeah, so you're right, late cycle. I mean, I think Jeffrey Gundlach said there hasn't been a recession that wasn't preceded by higher commodity prices since the post-war period, and we have, on a very modest scale, we have engaged both those asset classes. But, the operative word there, I think, is typically. Typically, this is what happens in, a late market cycle. Well, this entire market cycle has been anything but typical. The distortions created by things like ultra low 0% interest rates for elongated periods of time, quantitative easing, are unpredictable. So when we talk about late market cycle, it should be clear, and hopefully we're getting that point across. We're not talking about end market cycle. We're late market cycle. And there are strategies that have shown historically to have, late market cycle return characteristics. So to your question about tips, it was about 18 months ago. We put a very modest allocation into our portfolios, at least internally, into tips. Tips, by the way, are inflation-protected treasuries, essentially. They have an interest payout that adjusts annually with the rate of inflation with CPI. Tips underperformed the bond market last year. Tips are doing fantastic on a year-to-date basis. Commodities, we've discussed at length, both in reviews with clients. I've addressed it in the outlook. And here again, you get into late market timing. When is the right time to buy an outperforming asset class? So we put a very modest allocation into commodities, roughly 5% or so. About a year ago, shortly thereafter, we had kind of the exogenous issues of the Chinese trade battle. And then we had, a major hiccup in energy prices back in the fourth quarter. So commodities had a rough year last year. Year to date, commodities are up over 8%, I think, and it's doing fantastic. So the key here is that, there's a lot of, I think, smart people who've really studied this market cycle and think that given the untypical Fed actions over the last 10 years, late or not, this market cycle could last for quite a period of time. But we do have positions, we monitor them. The question is, do we add a little bit more here? Do we seek to raise those positions over time? The answer right now is be patient, and let things play out.
Well, and I think another issue too is the fact that when you look at the commodity index, right, that's primarily the largest portion of that is energy. And now oil prices seem to be playing within a tight band and don't have that same inflationary pressure that they have in the past. Is that
oil prices
fair?
Are firm. One thing to remember about energy in particular, oil specifically, is that the wild card is not supply and demand. The wild card is OPEC. And OPEC has shown some gravitas of late that it hasn't shown in many previous years. So yeah, oil prices have firmed up. I would say over 60% or so of the forecasts I've read have been looking for firmer oil prices in the future. And I think OPEC has flexed enough muscle that I don't necessarily think that we need to worry about OPEC. The other thing to consider, again, we go back to, and I mean it, the massive pivot done by the Fed. We now have a dovish Fed along with every other central bank in the world. And inflation is rising. It's not certainly runaway. It's not been typical late market, if you will, but inflation is rising and central banks around the world are reluctant to do anything about it. And they're probably allowing it to overshoot. So these are all going to play into the trading action of commodities. Hopefully our approach to commodities has not been as energy dependent as the major indexes are.
Thank you for tuning in to this quarter's webcast. If you have any questions, as always, please feel free to contact your advisor. John, thanks for everything, and we appreciate your insight as always.
All right, thank you and goodbye.